All right, dear student, this is the second session of the accounting equation. In the earlier session, we did the accounting equation, we discussed it, and we discussed numerous examples step by step in order to gain the understanding of this topic. Now we'll be doing a full exercise, and that full exercise will make sure that you are learning more things into it. We'll be dealing with the business transactions, and then we'll be putting those transactions into the accounting equation. So you have 9 transactions right in front of you on the right hand side of the screen. These are the 9 business transactions, and hopefully you can see it clearly, and we'll be putting that in the accounting equation. I'm using the Excel file to elaborate the concept because that makes it easier for me to describe. The first transaction which we are going to do is Donald introduced 50,000 into the business by paying money into a business bank account. Now, if you remember from the last lecture, accounting equation means assets is equal to liabilities plus capital. That means the assets of the business are financed by two sources. It is financed by the liabilities and it is financed by the capital. Now, capital is the investment of the owner. So first of all, what goes to the capital is the investment of the owner. And then we discuss how the changes will be accounted for. If the owner is introducing more capital into it, the profit will be added to the capital, the expenses will be deducted, the income will be added, the drawings will be deducted. So the two aspects, the duality concepts of the accounting equation means that you have to plot those aspects, those impacts into the accounting equation, and that will be the two impacts or two aspects. Donald introduced 50,000 into the business by paying money into a business bank account. So he is investing. Now, when he is investing, this is the investment which should be shown under the capital, 50,000 investment. And he is depositing that money into the business bank account. So what you're going to do is cash or bank, and this will be recorded under the assets. So at any point you see the 50,000 of the total, which is the highlighted area in the yellow color. So 50,000 of the assets equal to the 50,000 of the capital, because in the first transaction, there are no liabilities. Now you go to the second transaction, which says the business bought a motor van for 6,000. Payment was made by check. Business bought a motor van for 6,000. All right. So motor van is an asset. Motor van is a non-current asset. Hopefully you remember that chapter in which we discussed the assets, liabilities, and capital. So motor van is the asset which will be used for the business. So motor van, we will record that thing in the assets. All right. And the owner is not putting any investment for it. They are buying this asset from the existing cash. So there will be no change in the capital. The only change we're going to record is we were having the cash of 50,000. Now the 6,000 is being spent on the motor van. Now the remaining cash is the 44,000. So you can see the first impact is the decrease in the cash. The second impact is the increase in the motor van. So these are the two impacts that you just plotted into the accounting equation. Now we have transaction number 3. The business bought some inventory for 3,000 paying by check. Again, they are buying the inventory. Inventory is a current asset, if you remember. So it's an asset that will be recorded under the asset. And they're buying this inventory on cash, paying through check. That means simply the cash they're using for it from the bank. So they were having the cash of 44,000 previously. Now they have bought the 3,000 inventory. The remaining cash is 41,000. Again, there's no liabilities because you have not bought anything on credit. Again, there's no change in capital because you are buying the inventory from the existing cash the business has. So the cash remains 41,000. The decrease in the cash is the first impact. The second impact is the increase in the inventory. These are the two aspects that we recorded in the accounting equation. Now we are moving towards the transaction number 4. All the inventory purchased in the transaction number 3, which was worth 3,000, was sold for 5,000 in cash. So the inventory is being sold. That means there will be no inventory in the transaction number 4 because all the inventory has been sold, and it has been sold for 5,000. So remember, in the previous transaction we were having the cash of 41,000. Now 5,000 cash means now we are having 46,000 cash. So the first impact is the increase in the cash. The first impact is the increase in the cash, and there's no longer inventory. And we have sold inventory of 3,000 for 5,000, making 2,000 as profit. And as you know, the profit belongs to the owner, so that profit will be added to the capital. So now the capital is 52,000 and the assets are 52,000. So the equation is balanced. Again, there are no liabilities now. Now we are moving towards the transaction number 5. And what it says, transaction number 5, more inventory was purchased for 10,000. The purchase was on credit. Now you have purchased more inventory. Again, inventory is your current asset. So we're going to record the inventory in the assets. There's no change in cash because we are buying on credit. There's no change in the motor van. But because we are buying the inventory on credit, that makes a liability on us. Now we have to pay this 10,000 to our payables. So this 10,000 will be recorded under the liabilities. The capital area remains same. So assets equal to 62,000. Liabilities plus capital is 62,000. Out of 62,000, 10,000 is your liability and the rest is your capital. Now we are moving towards the transaction number 6, which says 50% of the inventory purchase. Now we purchased the inventory of 10,000. 50% means 5,000. 50% of the inventory purchase in the transaction number 5 was sold for 8,000. All of these were on credit. Now we have sold the inventory in the transaction number 6, 50% of inventory, which means 5,000 for 8,000. So that means, first of all, we have to reduce our inventory of 10,000 to the 5,000 because we have sold 5,000 from it. The second thing is that we have sold this inventory on credit. That means there will be no change in the cash. In fact, we have to receive this amount from someone, and that is known as the receivable or trade receivable, which you studied in the earlier lecture. So that person owes us the money. That person owes the money. He has to pay 8,000. So that is our receivable, again the current asset. The third thing you need to understand is the inventory worth 5,000 was sold for 8,000. That means again incurring the profit of 3,000. Previously the profit was 2,000. 3,000 will be added to that, making it 5,000. So the remaining capital, the total capital now, sorry, is actually 55,000. So 55,000 is the capital, 10,000 is the payable, total is 65,000, and again assets are 65,000. This is transaction number 6. Now we are moving towards the transaction number 7, and what it says, a payment of 3,000 was made to a supplier for some of the purchases. Do you know we have the payable of 10,000? So we are making 3,000 payment to that supplier. So what is going to be the impact is we were having the cash of 46,000. Now the 3,000 has been paid out of it. So the remaining cash is 43,000. Meanwhile, we also reduce our liability to 7,000 because we were having a 10,000. Now 3,000 has been paid from it. The remaining is the 7,000. So the capital and liabilities are 62,000. Assets are 62,000. The equation is balanced. Now we are moving towards transaction number 8, which says a payment of 4,000 was received from a customer from some of the sales on credit. Do you remember the receivable we were having of 8,000? Now that person has paid us 4,000 from it. So we'll reduce the receivables, and now it is 4,000. The remaining the remaining receivable is 4,000, and the cash we were having 43,000. 4,000 will be added to that, and the remaining and the new cash is 47,000. The last transaction we are having is Donald drew 1,000 from the bank account for his personal use. So these are the drawings. And do you remember drawings will be deducted from the capital? So 1,000 cash, we were having 47,000. 1,000 has been taken from it. Remaining cash is 46,000, and this drawings will be deducted from the capital. So total assets 61,000, liabilities and capital 61,000. This is how you plot the transaction into the accounting equation. This was just a supporting exercise to make your concepts even more better.